Now, I talk trash a lot about people who think tax planning is just a one-time deal every year. You've seen that in many of my videos, but it's not, okay? It's not just something that you do when your taxes are filed. Because if you're a little bit more advanced, or maybe you're meeting with an advisor that actually does tax planning, there's a couple different conversations that probably sound familiar to you. Deferring taxes until you retire, maxing out your retirement accounts each year, doing what you're told is tax efficient. And then you retire and the mindset kind of just stays the same. But once you retire, that's where the game actually changes, because you're no longer earning income the same way. You're creating your own income stream from the assets that you've built over your lifetime. And that means for the very first time in a very long time, you have real control over how your income shows up on your tax return. Now, that control can work for you or it can work against you. So today, I'm going to walk through 3 tax mistakes that show up over and over and over and over again in retirement that I've seen. They're not really complicated, but they get overlooked very easily. So we'll jump right in. Now, the first big tax mistake is letting the early retirement years go unused, because this is a stretch of time in retirement that most people typically don't plan around it. It kind of just shows up. And if you're not ready for it, it might smack you in the face like a ton of bricks. Ouch! And I'm assuming that hurts. It never happened to me, but I'm assuming it hurts. So you stop working, you're not getting your usual paycheck that you're used to, and maybe your other income hasn't turned on quite yet. Okay, so you don't have Social Security. You're not forced to take distributions from your IRAs and those silly little things called RMDs. And maybe you've got some withdrawals here and there, but nothing's actually structured and being planned, right? So this can be a very quiet period if you're looking at it from like a 10,000-foot view. But from a tax standpoint, it's one of the most important windows that you'll likely ever have. Because your income is lower, you have room to decide what you want to do with that space. It's like, if you're living in a 3-bedroom house and you upgrade to a 4-bedroom house, not because you're family planning or something, but it's like, what do I do with that extra room? I mean, what do people do with that extra room? Well, the extra space in those income years, it might mean, well, maybe taking distributions at lower tax rates, like accelerating your income. Or maybe you realize capital gains a little bit more intentionally, at lower rates. Gradually shifting assets into more optimized buckets instead of waiting to be forced to take distributions. Well, what usually happens instead is nothing. Your income stays low. You feel like, man, this is really efficient. You're happy that you're paying like little to no taxes when your tax return gets filed. And that decision just kind of carries forward until a shift happens. And years later, or maybe sooner rather than later, your income starts to stack. Your Social Security turns on. Maybe now you've got RMDs to deal with. You still have the regular withdrawals that you were doing. And maybe you have a pension or something that's kicked in. Now that flexibility that existed is gone. The gap wasn't just a transition period, okay? You were supposed to do something with that. It was an opportunity to shape everything that comes after it. So I just met with this couple for the first time, all right? And I'm going to use them as an example. They both just turned 72 and are shocked that all of a sudden they went from not paying any taxes to having to pay a lot more than they expected. Now, they are still in pretty relatively low tax brackets, but they still didn't expect it, okay? They're very frugal spenders, right? They were living off of just their Social Security benefits and a very nominal distribution out of their IRA. It was like $1,500 per month. But unbeknownst to them, that once their RMDs start this year, well, now all of a sudden their Social Security benefits are being taxed up to 85%. Their capital gains went from a 0% tax rate to 15% tax rate. And now they have to make decisions as to what to do with the extra cash flows that they are being forced to receive. Now, that's a tough pill to swallow for some folks who didn't plan ahead of time for this. Had they met with us 5 years ago, of course, I don't have a time machine. I can't go back and help them 5 years ago. But had they had 5 years of doing some proactive planning, maybe accelerating their income or doing Roth conversions, it could have substantially changed what their tax situation looks like from here on out. Now, the second tax mistake is treating Social Security like it exists on its own, like it's independent. Once Social Security enters the picture, the complexity doesn't come from the benefit itself. It comes from how it interacts with everything else. And what a lot of people don't realize is that it can be taxed depending on what your other income is. That's what determines how much of it is taxed. It's called provisional income. So you want to treat your Social Security benefits more like a moving piece. As your income increases from other sources, more of your Social Security becomes taxable. And it doesn't happen all at once. It kind of just phases in. So you have your income from your IRA withdrawals, investment income like capital gains and dividends, and any other sources you may have like a pension or annuities. That's what determines your provisional income. It doesn't just stand on its own. It influences how much of your Social Security is going to be pulled into your taxable income. So if we think back about the couple that I just met with, they were sitting in that lower income range for quite a few years, and they paid little to no tax on their Social Security. I think this past tax year, it was about 24% of their benefits actually being taxed. But due to their overall income being so low and the high amount of standard deduction and senior credits that they receive now, they made out like a bandit. They paid zero in taxes. So yes, the 0% tax bracket does exist. But now, moving forward, they are forced to take more out of the IRAs due to those pesky little required minimum distributions. And they're not just increasing your overall taxable income, they're increasing the portion of Social Security that's exposed. And in this case, up to the full amount allowable, which is 85%. So it creates this layered effect where each additional dollar of income, it carries more weight than expected. And that's where people start to lose focus on this stuff. They think they're operating within a certain tax bracket, like 12% marginal tax bracket, but in reality, their effective rate starts getting higher because of how those pieces are interacting with each other. What makes it difficult is like, hey, this is not intuitive. People are not taught this stuff in school or even college courses unless you are in a very strict finance or, I don't even think some economic courses, they don't go over this unless you're getting into like a financial planning field. So what I'm trying to tell you here is you can't just look at each source independently. You have to look at how they stack with each other. And more importantly, when they start showing up, because timing matters just as much as the source itself. The last mistake here is treating Roth conversions like a one-time decision. And now you're probably thinking like, oh, you guys talk about Roth a lot. Well, yeah, it's because it's one of the most talked about resources out there. It's like the hottest topic. You go to any YouTube video or podcast, they're talking about Roth conversions. But it's for good reason, because done properly, they can create a lot of flexibility in retirement. So pretty much everyone has heard of Roth conversions by now, but how they're being implemented is an entirely different story. It's typically viewed as a very binary decision. You're either doing Roth conversions or you're not. But how they get realized in an actual planning scenario is they should be a series of decisions that kind of unfold over time. Okay, and so we'll look at both ends of that. On one end, you've got people who just avoid them entirely. They firmly believe that they are going to be in lower tax brackets in retirement. And just like advisors have been telling people for decades, like, hey, you're going to be in a lower tax bracket in retirement, right? I'm sure a lot of us have heard that. But then they retire with most of their assets in these pre-tax accounts like IRAs and 401ks, and they kind of just let everything play out as is. It feels very manageable early on, especially if their withdrawals are, small to moderate, taxes are reasonable, but over time, your income is going to start building higher, just like we just said. Social Security turns on, distributions increase because, maybe you're trying to keep up with your neighbors on buying cool stuff or, lifestyle creep. Eventually, you're going to have those pesky RMDs that we've been talking about. Not everything is taxed at once, by the way. So it leaves you kind of with very little flexibility once those things start getting tacked on. So then on the other end, you have people who recognize these types of risks, and then they swing like hard in the opposite direction. Maybe they believe that taxes are 100% without a doubt going up in the future, or maybe they just don't want to have their kids or grandkids or whoever's inheriting their accounts pay taxes on the money they leave behind. So they come to us and they're like, oh, I want to convert everything in my account. They do very aggressive Roth conversions, like real big, large amounts early on, trying to get ahead of future taxes. But that's kind of where it breaks down because we don't know what the tax rates are going to be in the future. Conversions only make sense within a certain range. And it's usually a level of income where the tax rate is acceptable and the long-term benefit is clear. But once you go beyond that, you're not just managing your taxes, you're accelerating them when you maybe not need to. And that can undo the benefit of a Roth conversion entirely. If you remember from my previous videos, the main goal of Roth conversions is to obtain tax arbitrage. Okay? And whether the arbitrage comes during your lifetime or when your loved ones inherit your assets when you pass, the theme is the same. Are you going to pay less taxes when you take the money out versus when you put the money in? There's just a lot of variables in the future that we can't determine right now, and unfortunately my crystal ball is broken, so I can't tell you. So the real question is not, should I do a Roth conversion? It's more along the lines of, how will a Roth conversion benefit me and or my kids in the future as far as taxes go? The answer is going to change depending on what's going on in your life, but it's something that should be asked and evaluated year by year. So that takes us to the uncharted territory of today's episode. Now, all of these mistakes have one thing in common. They assume that retirement income is static, it's stable. It's just your accounts, you have your withdrawals, pay your taxes, and that's it. It's just the same scenario over and over again. But retirement income has phases, just like your life and your career and your family. It's all had its own different phases that you went through. So the early years of retirement are going to look one way. You're going to have lighter income, more flexibility, better health, hopefully, and more things to knock off your bucket list while you still can. And then the later years of retirement are probably going to look a lot different. More fixed income, less control, more layering on these different things. You're probably just going to be sitting on your couch watching Jeopardy more. I don't know. But what's happening in that first phase, when you still have the flexibility, that's what's going to determine the structure of the second phase and how efficient it is long term. So if those early years are left unplanned, you're not going to end up with higher income later. You're also going to have income that's already decided by the IRS. That's fun, right? That's what everybody wants. Fixed sources, stacked distributions, and tax exposure that you can't easily unwind. Look, I'm not trying to scare you, but at that point, you're not designing anything. You're not planning the rest of your retirement. You're just managing what's already in motion. So that's where there's a subtle shift, okay? The focus moves away from what do I need this year to what do I want this to look like over time, okay? Because once you start thinking in that framework, all the pieces start to connect. Early withdrawals gain more purpose. Your conversions become measured and strategic, and your income sources start to be sequenced intentionally. Taxes, they'll stop being a byproduct of everything else and start becoming a priority and part of the design of your financial plan. And it's not a different strategy, it's just a different perspective on the same decisions. So in closing, if you're just reacting to your taxes year by year, again, you're not doing tax planning, you're doing tax paying. You're just a regular old taxpayer. You really need to recognize where you have flexibility and actually use it before that window narrows. Because once the income becomes layered and fixed, your options get a lot smaller. And then you're just stuck with whatever the IRS says moving forward. I think we already agreed that that's not the most optimal decision. There shouldn't be any questions about whether taxes are going to impact your plan, because they will. In fact, that's one of my favorite things to tell people, is that the two biggest expenses in retirement are, number one, your taxes, and number two, your health care. Now, I can't help you eat right or maintain a healthy lifestyle. Of course, I can tell you to stop eating, ding-dongs and Twinkies on your couch, but I can help you maybe try and make better decisions. But when it comes to taxes, I can actually guide you and help you and try and minimize your overall tax liability, because that's where the real tax planning occurs. If that's something that you want to walk through, maybe look at how your income unfolds over the next 10, 15, 20 years. That's the type of work that we do with our clients. So click the link in the description below to reach out and get something scheduled. Now, if you're listening to us on Spotify, first of all, thank you. Please give us a 5-star review if you find this helpful. The full video version and the scheduling link is available on our YouTube channel. Just search SWBC Uncharted Wealth. If this episode was helpful, please share it with somebody that's getting close to retirement, or really anybody that is unhappy with their tax situation. There's probably a way we can help them as well, because these are decisions that carry a lot more weight than they appear to early on. Again, anything that I talk about on these episodes are not to be taken as legal, tax, or financial advice, and all of my opinions are my own opinions. We'll see you next time on Uncharted Wealth. Peace. Maybe it's a party room. What do you think? I don't know why I'm asking you off camera.
So much room for activities.
So much room for activities.
Killed that.
I killed that. A window. You see what I'm seeing? It's like throwing me off just a little tad. Drop it like it's hot a little bit.
Investing involves certain risks, including possible loss of principal. You should understand and carefully consider a strategy's objectives, risks, fees, and expenses, and other information before investing. The views expressed in this commentary are subject to change and are not intended to be a recommendation or investment advice. Such views do not take into account the individual financial circumstances or objectives of any other investor that receives them. This information should not be considered a solicitation nor a recommendation of an offer to provide any service in any jurisdiction where it would be unlawful to do so under the laws of that jurisdiction. Past performance is no guarantee of future results. Please consult with your individual tax professionals and/or attorney for additional information.